Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Mandeep Singh is here with us. He's the Global Tech Research Head. And Mandeep, this idea of big tech being called upon to pay for their own rising energy costs. As Bailey pointed out, this is all through a non-binding statement of principles. He pointed out the winners and losers on the utility side. What does this mean for big tech? I mean, can any of them come out of this ahead with something like this kind of pressure?
Well, right now, I think everyone is looking at gigawatt data centers, right? And when you think about what is existing in terms of AI data centers, these are 50 to 100 megawatt data centers. We are already talking about power requirements going 10x to 1 gigawatt. Mm-hmm. And so how will a 70 to 80-year-old grid supply electricity, which is 10 times more than what these data centers already consume? And so from that perspective, it is a very topical question that needs to be asked. Where are you getting the 10 times power that you need to run your 1 gigawatt data center? And I think that's the realization that's coming in now. It's being reflected in the prices that consumers have to pay because prices have gone up for electricity. But I mean, the computing that AI does requires 10 times more power.
We're only getting started.
That's the realization. And I think everything will follow through now.
Mandeep, is there a sense that big tech leaders might be open to working with the White House on this to kind of be in Trump's favor here? And what might the impact be on their profit growth?
I mean, there's no doubt that AI data centers are a much lower gross margin business for hyperscalers. And these hyperscalers, I mean, Amazon, Microsoft, and Google, the three big ones, have huge footprint when it comes to the traditional CPU data centers. They were able to get to, 65 to 70% gross margins on the public cloud businesses they had. Now with AI workloads, we're talking about a sub 50% gross margin business. No matter what kind of scale you have, just because of the economics involved, these are sub 50% gross margin businesses. So on-premise software used to be 80 to 90% gross margin. With public cloud, we got to 65 to 70. With AI, we are sub 50 gross margin. So from that perspective, I mean, even if you're Microsoft, you don't have a choice, but your margins will have to come down.
We're also looking at semiconductor stocks as the best performers in the S&P 500 by 24 industry groups. And it feels like that TSMC bullish forecast was very much a tailwind for the industry. Obviously, this is good news in terms of demand, but does anyone lose out here when TSMC can't even meet the demand that is being required of it?
Well, lose out, I think, what we've seen really is Intel really benefiting. So I wouldn't say anybody is losing out, but clearly everyone is so focused right now on the AI side that I feel suddenly everyone realized, storage is in short supply. We didn't talk about storage up until, the beginning of this year. So there will be, instances like this where one of the components gets neglected and suddenly everyone finds that to be in short supply when you need it. So it could happen. I think CPUs. Nobody talked about CPUs in the past 12 months. Suddenly CPUs are in short supply. So that's where, the IT infrastructure needs to be upgraded every 4 or 5 years. And when the time comes to upgrade the infrastructure, certain components, even if they're not tied to AI, could be in short supply because we have reallocated the resources towards meeting the AI demands.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Some earnings that we want to bring your attention to. J.B. Hunt, the truck carrier, reporting quarterly revenue that missed analyst estimates, although some people might say that the bar was kind of high for this company, even as we've seen this continued weakness in freight demand. Lee Klaskow is Bloomberg Intelligence's Senior Transport, Logistics, and Shipping Analyst, and he joins us now to give us his take on what we're seeing. So what is the story with J.B. Hunt and how it's positioned for the current market environment?
Yeah, if you take a look at the stock, it's been up a lot over the last couple months, and some of that has been in anticipation of the trucking spot market to kind of turn more positively, and that would be through more supply coming out of the market. So the stock is off a little bit off today. It was off a lot in the aftermarkets last night, but it's come back a little bit, and that's really being driven, I think, because of that kind of high expectations. But at the end of the day, the company did report a pretty good print. Their earnings came in above consensus. It was driven by their intermodal, their truckload, and their final mile businesses. J.B. Hunt is a kind of an integrated transportation company. They provide a lot of different types of transportation services. Some of the ones that fell maybe short of expectations were their freight brokerage business and dedicated business. And that, the dedicated business is being driven by, it takes, they're winning business, but it takes a while for some of those businesses to ramp up and to kind of drive the margins that they're expected to, because those ramp up costs. What I would say is that I think a lot of people were somewhat surprised by management's tone on the earnings call last night. They noted that the market was fragile and that the supply that we've been seeing coming out of the truckload market, while it's been good, they don't want to get ahead of themselves and call this, we're in full recovery mode because, we've had some false positives in the past. So they were pretty, I guess, cautiously optimistic about the outlook when it comes to the truck spot market. And that's so important because once the truck spot market tightens, rates will go up in that market, and that will kind of ripple across its contractual business, its dedicated business, its brokerage business, its intermodal business. So it's kind of like the canary in the coal mine for freight transportation and logistics providers.
Lee, J.B. Hunt is, of course, a big macroeconomic bellwether. What is it telling us about the broader economy and the year ahead?
Yeah, companies like this will really do well when demand grows, obviously. They have seen, a somewhat resilient consumer. They did note that, while there wasn't a lot of imports coming into the country for peak season, they benefited from a lot of freight that was already in the country moving across the country. So it does seem like, they did see some peak demand during the fourth quarter, which is obviously positive. But, I don't need to tell you guys, it does seem like this economy is a K-shaped economy, and it's really not kind of a widespread economic growth that we're seeing, where there's pockets of strength and pockets of weakness.
So cost cuts helped limit the downside for J.B. Hunt. Is that the catalyst to get people excited again about J.B. Hunt? What kind of cost savings it can realize this year? Maybe it can go further than what it had projected when it comes to reducing expenses?
Yeah, I think there's two things here that people can get excited about. I think there is the prospect of a better pricing environment for J.B. Hunt and the broader transports. That's one. Secondly, they're not just sitting on and resting on their laurels. They are actively trying to take out costs. They took out around $25 million in the fourth quarter. Their run rate was somewhat over $100 million. Management didn't really want to guide too much on what they expect that they can take out in 2026, but I suspect that they're going to continue, that trend next year, and they could bring some of their, margin targets. Most of their margins right now are trending below their kind of long-term targets, and through these cost-cutting initiatives, productivity gains, and it's not just cutting to the bone. We're not talking about that. They're trying to get more productive. So whether it's better utilization rates of their trailers, maybe it's better quicker turns for their drayage fleet. All these things will lower the overall cost. And if you put on top of that higher rates, it really could drive margins significantly higher and closer to those longer term targets.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Saks Global filed for Chapter 11 bankruptcy protection, a humbling turn for the luxury retailer following a stretch of losses, flagging turnaround efforts, and a substantial merger-related debt. There are also hidden costs to luxury consumers and brands. To discuss this with us is Rania Sedhom, managing partner at Sedom Law Group. Rania, what does this bankruptcy mean also for Saks' shoppers and the brands that work with it?
A lot of the brands that worked with it are no longer working with it, which also, precipitated its decline. It is sad, as you were saying, and I'm sure it's humbling. So it started, I would say, at least a year and a half ago. I started hearing from smaller brands, some of whose only footprint in the United States is with Saks Fifth Avenue and Neiman Marcus Group, which is owned by the same company. They were not paying for consigned goods, although the goods were selling. So this was the start of the end, really. And if you've tried to go shopping recently at Saks Fifth Avenue, you will notice a shift in the products that are available to you, and this is one of the reasons. For consumers, it's tough to say when there's a bankruptcy estate, they do not have to honor any kind of credit or rewards program, but I understand in this instance they will be honoring it. Mm-hmm. The issue becomes for you, is there something there that you want to purchase, and how are you feeling about the brand in general? Something that I think Saks did poorly was communicate. I received my first email from them about the bankruptcy yesterday. Nothing prior to yesterday. So I think there's some room for growth there on the communication end. And, going back to the brands, what's going to happen to them? It's too late, for them to do anything. But on a going forward basis, if you are a brand and you're consigning your goods, there are a few things that you need to look out for. The first thing is your contractual provision. It should state in this agreement that you own your merchandise until it is sold. That's the very first thing. And then once that provision is there, there's something called a UCC filing. You should file a lien because this will give you an interest in the merchandise and you're no longer an unsecured creditor for purposes of bankruptcy. So you may actually get something.
So there's legal recourse for the vendors of Saks, many of which were not getting paid regularly in the last couple of months. How does Saks go about repairing its relationship, not just with customers, but with these brands, the brands that it relies on in order to bring customers through the doors?
Yeah, I think, people really discount the efficacy of good communication. But, as an attorney, I can tell you that is of paramount importance. In fact, usually when there's a breakdown in a relationship, it's because of communication. So the first thing that Saks needs to do, in my mind, is tell everyone why this happened and what steps they're taking to remedy it, because we don't want them to be repeat offenders. 5 years from now, we don't want to be sitting in the studio talking about the other bankruptcy that they're undergoing. So it's important to figure out the why when it's such a drastic step that you have to take. And tell your vendors what you're doing and help build trust again.
Rania, when you get this type of bankruptcy filing, what does Saks owe its investors and creditors?
Well, I don't know what the numbers are. However, the bankruptcy code ranks people by importance, secured versus unsecured. And, the landlord is certainly a secured creditor to the extent that they owe them money. They will be paid first. Any kind of loan, they'll be paid, amongst one of the first as well. So it's too early. I don't have the list yet.
You were talking about some of the M&A debt, and this bankruptcy, of course, comes a year after investors handed Saks billions of dollars for its acquisition of Neiman Marcus, which was also struggling. What kind of risk was it putting investors through by acquiring Neiman Marcus?
I'm not sure that marriage was off to a good start from the beginning. We as shoppers, I can speak for women, or at least for myself, we shop at a whole host of different places, and you could have one customer shop in multiple stores for different types of items. But in general, it's safe to say that the Neiman Marcus Group shopper is not the same. as the Saks Fifth Avenue shopper, who's not the same as Bloomingdale's or Macy's shopper. So I think that marriage was rocky to begin with, and it was a hefty price that was paid. I'm hoping, as a consumer, and for everyone's sake, that someone else buys Neiman Marcus Group, or perhaps they can buy themselves back. We do see that sometimes, where you purchase yourself back from your acquirer.
Yeah, I just went across the street to Saks off Fifth thinking that I could get a nice
that's
deal on
closed.
something, and they just, got rid of everything.
Yes.
What is next for Saks here? Do you think it makes it out of this?
I think Saks does make it out of this, but I'm an optimist by nature, just so everyone listening knows that. But I do think they're going to have to contract in order to grow. So this is a time to be extremely self-aware, extremely scrutinous, and determine which stores are going to provide you with the most relevance to your customers, and which ones can you stock well and have preeminent customer service, and then close the others. You can always reopen stores. It's not a good idea to just have a huge footprint that's lackluster.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
John, when was the last time you ate at McDonald's or Taco Bell?
It's been a while. Taco Bell, never. McDonald's, maybe like years. Look at me. I can't eat that stuff anyway.
Well, apparently
it is approaching noontime, so lunch is here.
Yeah,
Where are we
maybe
going?
you'll have to go there for lunch. We'll have to check out Taco Bell. Apparently, those restaurants are going to get a boost from December economic data that is poised to lift U.S. restaurant same-store sales. That's along with cheaper gas prices and relief from new tax rules. We'll get more into this with Michael Halen, Bloomberg Intelligence Senior Restaurant and Food Services Analyst. Michael, what is your outlook for restaurant sales going into 2026?
Yeah, we think sales are set to improve here in 2026, especially in the first half. Gasoline prices are down, 13-ish% versus 1Q of last year. We're lapping, bad weather, cold weather, snow, and a really bad flu season from a year ago. And then we have tax relief, which historically really helps restaurant spending. And and then we have a couple things on the upside. I mean, this administration is looking into potentially credit card reform, and I don't know if they're done with the tax reform, and we could see more interest rate cuts. So all of those things we think are going to feed into better consumer sentiment, and we saw that in some of the economic data last month, and we think it spells a much better year for restaurant spending.
We're talking about Daniel Boulud's restaurants or Mickey D's?
Well, we think McDonald's, a lot of the chains we cover are going to benefit, but we think, McDonald's and Taco Bell in our most recent note were two that we pointed to because low-income consumer are going to benefit from the tax reform. They're the segment of the consumer that have kind of pulled back from restaurants in the last couple of years, and so giving them a boost with tax reform. They're the ones that are most sensitive to gasoline prices, so the cheaper gas is going to help them the most. And like I said, we've seen it in the consumer sentiment data that the improvement in University of Michigan consumer sentiment was due to low-income consumers. So these things are all pointing to better results at fast food chains like McDonald's and Taco Bell.
Are there any specific chains that you think will be bigger beneficiaries than others?
Well, outside of those two, Cava and Wingstop are a couple of the names that we think can have big bounce back years. Cava, in a vacuum, it had a very good year, right? But they didn't hit lofty targets that they had set, and earnings slowed off of a very strong 2024. And so we think they're set up really nicely to see an acceleration here in same-store sales, and kind of the same thing in Wingstop. Both of them were victims in 2025 of incredible 2024 success, and now that they have much more reasonable same-store sales comps to lap, we think we could see a big boost there. Wingstop, one of the big things that they have going on is a new smart kitchens that are going to massively help the operations, improve speed of service, and get people their wings hotter and faster.
Oh, okay. What are you talking about? The intersection of AI and chicken wings?
Yeah, I mean, restaurant business. Listen, the restaurant business, man, has been historically underinvested in technology, and they've been quickly trying to catch up.
Pan and a deep fryer. What technology?
Yeah, well, listen, when you go and sit down in a restaurant and you have 5 people ordering 5 different things, right? You don't start them all at the same time, right? Like your sushi is going to be done a lot, maybe faster or slower than my chicken teriyaki, right? And so technology is being used in the kitchen to let the cooks know when to fire each meal so that everything comes out at the exact same time hot, right? So there's definitely a lot of uses for artificial intelligence and smart kitchens in this industry.
So Michael, what does that mean? Are we going to go into a McDonald's and see robots making our fries? What does this mean for jobs at restaurant chains?
Well, restaurant chains have been able to reduce labor hours by increasing the amount of automation. Me personally, I don't think we're going to go into restaurants that don't have humans working in them anytime soon, or maybe ever. But you'll continue to see kiosks, right? Because that takes away labor at the counter. You'll continue to see upgrades to kitchens and more kitchen automation to help decrease the labor needs in the kitchen. It will continue to be a point of focus as minimum wage continues to increase and labor continues to become hard to find. So it's going to continue to move this direction. Like I said, this business has underinvested in technology for a very long time, and so they have a long way to catch up to, competitors, say in packaged food, where their plants are very automated.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.